Hello and welcome. The big news in financial markets over recent weeks, and indeed really over recent months, has been around monetary policy from the world's major central banks, and of course around inflation. On monetary policy, money and bond markets have broadly come now around to the view that central banks have to fight harder to contain inflation in the longer term. And as such, the optimistic expectations about the possibility of interest rate cuts later this year have been dashed. The rate at which the markets now think the official US base rate will peak has moved higher from 4.8% to 5.2%. Now, the reasons for this reassessment are twofold. Firstly, the US Federal Reserve itself has used several speeches to remind the market that they do not share this belief about rate cuts later this year. And the second reason is, it's the inflation data itself. In the US, the consumer price index fell to 6.4% in January from a peak of 9% in June last year. And core inflation, removing the volatile food and energy costs, was 5.6% in January over a year ago, compared to 6.6% late last year. So inflation does seem to have peaked, but it's remaining well above the Federal Reserve's 2% target rate. The major ongoing concern for policymakers is that services inflation has yet to peak, with the last reading just under 7.5%. So there is still some work to do before the battle with inflation is won. Now, in the UK, inflation has similarly peaked, both in terms of headline and core inflation. In UK, services price inflation looks to be past its peak, unlike the US, but goods prices are running a lot hotter here than in the US. But here, on the goods front side, the news is good from the UK producer price indices, as these seem to have now peaked or begun to decelerate, and that should pass through to UK consumer prices in coming months. But the level of inflation remains high and well above the Bank of England's target, also set at 2%. So that's why in the UK, as well as the US, expectations for rate rises have increased in recent weeks. Now, Nutmeg portfolios have anticipated this rate rise, being underexposed to government bonds and interest rate risk, and we continue to monitor this position very carefully. So thanks for watching, and for more thoughts from the investment team, visit the Nutmeg app or the Nutmegonomics section of our website.